Good day, everyone. We are pleased to welcome Amit Mitra, Partner Audit and Assurance, MSK and Associates, to help us navigate the regulatory landscape in his session on amendments and updates in today's Insync with BDO India. Over to you, Amit. Thank you.
Thank you, Pallavi, for the introduction. Hello, everyone, and welcome to our session on the latest updates and amendments, which this time are primarily from the Securities and Exchange Board of India and the Institute of Chartered Accountants of India. Today, we will be covering several important topics that are critical for staying compliant and informed in our industry. These include the SEBI LODR, the ICDR amendments, the BRSR consultation paper, and recent ICI announcement. But before we begin to look at these amendments, let's understand the need and the purpose behind such amendments or updates. These amendments reflect SEBI's ongoing effort to make capital market more accessible and efficient for issuer while ensuring robust investor protection. SEBI aims to create a more streamlined and flexible regulatory framework by simplifying processes, reducing compliance burden, and ensuring that the capital market regulators are adaptive to the ever-evolving business changes. The amendments to the ICDR regulations were needed to address various operational challenges faced by the issuer. Steps were needed to provide more flexibility to issuers in meeting their funding requirements, ensuring timely and efficient capital raising activities, thereby making the market more responsive to the issuer's needs. The BRSR consultation paper were issued to address the complexities and high cost associated with the current BRSR framework. The proposed changes aim to simplify the reporting process, reduce the compliance burden on the companies, and ensure that disclosures are more relevant and aligned with the global best practices. The ICA guidance aims to enhance the overall quality of the audits and that the audit firms adhere to the highest standards of professional practice. We will dwell on the observations noted by the Quality Review Board. Of course, the idea of all this is to ensure the highest standards of compliance, improve transparency, and trust in the financial reporting ecosystem. Okay, we will start with SEBI LODR amendment, move on to SEBI ICDR amendments, discuss the BRSR consultation paper, and finally review the latest announcement from ICI, including the QRB observations. Okay, moving on. The 17th May 2024 update on Regulation 30 Subclause 11 now requires listed entities to confirm, deny, or clarify market rumors reported in mainstream media. This amendment is aimed at increasing transparency and ensuring that accurate information is available to the public. This requirement applies to top 100 listed entities from June 1 of this year and to top 250 listed entities from December 1, 2024. Therefore, now listed entities are required to verify market rumor if there is a material price movement in their securities. This requirement is crucial as it ensures that any rumors which could potentially impact the market price are addressed promptly. By doing so, SEBI now aims to protect the investors from misinformation and helps to address the speculative trading. This regulation is a significant step towards enhancing transparency and trust in the market. Now, moving on, amendment in the consideration of the unaffected price. For transactions where SEBI regulations or stock exchange price norms are applicable, the unaffected price should be considered. This is determined by excluding the impact of material price movement and the confirmation of the rumor. This amendment was necessary to ensure that pricing of securities reflect their true values, unaffected by speculative activities or market rumors. Another significant change is in the obligation placed on the promoters, directors, key managerial person, and senior management. They are now required to provide timely responses for verifying a market rumor. This inclusion ensures that those in key positions are actively involved in maintaining market integrity and transparency. Their prompt response can help in quick verification and addressing of rumors, thereby reducing uncertainty and speculation in the market. Moving on now to SEBI circular dated May 21, 2024 on unaffected price framework. Now, to aid the listed entities in meeting their obligation concerning market rumors, the Industry Standard Forum, the ISF, in consultation with SEBI has developed industry standards. The industry standard note issued by ISF outlines standard operating procedures for complying with rumor verification mandate. These procedures are structured into three sections: the general aspect, merger and acquisition transaction, and non-merger and acquisition transaction. Additionally, the NSE and BSE, in conjunction with SEBI, have also devised a framework for listed entities to comply with when verifying rumors following material price movement. This framework includes parameters for identifying material price movements and monitoring measures by stock exchanges. The emphasis on material price movement ensures that only significant rumors that can impact the prices are addressed, enhancing the efficiency of the verification process. These underscore SEBI's focus on ensuring transparency and maintaining market integrity. As per the existing regulations, only rumors pertaining to material events were required. However, this amendment provision now stipulates that any market rumor should be verified, if there is a material price movement, of course. Therefore, the scope has been broadened, reducing the potential market manipulation and eventually increasing the investors' confidence. Therefore, now the unaffected price is determined by excluding the impact of any material price movement and the confirmation of the rumor. This means that when a rumor causes significant price volatility, the unaffected price serves as a benchmark to understand the security's value. The SEBI circular also includes specific methodologies and criteria for calculating unaffected prices. On the Regulation 3 update, an important aspect of the recent amendment is the introduction of average market capitalization criteria under Regulation 3. This regulation mandates that the market capitalization based requirement should be determined based on the average market capitalization from July 1 to December 31, instead of using a single day market capitalization, traditionally March 31 for us. The rationale behind this change is to provide a more stable and representative measure of a company's market value, which can otherwise be distorted by short-term volatility or anomalous trading activity on a specific day. Every stock exchange is required to prepare the ranking of listed entities based on their average market capitalization as of December 31 each year. Consequently, the relevant provision will apply to listed entities from April 1 or from the beginning of the immediate next financial year, whichever is later. This approach ensures that the assessment of company's size, market position is more balanced and reflective of its overall performance over a substantial period. Additionally, the regulations introduces a sunset clause of 3 years for the cessation of applicability of market capitalization based provision. This means that the criteria will be reviewed and potentially revised after 3 years, ensuring that the regulations remain relevant and effective in the changing market landscape. By adopting this average-based method, SEBI aims to reduce the impact of short-term market fluctuations on regulatory compliances and ensure that the criteria for market capitalization are fair and consistent. This amendment enhances the accuracy of market capitalization assessment, thereby prompting a more stable and reliable regulatory environment. Now, moving on to updates regarding BRSR. Regulation 3 has introduced significant updates concerning BRSR. Now, listed entities are required to establish robust systems and processes to capture data necessary for BRSR reporting. This implementation must be completed within a period of 3 months from December 31. Following the establishment of these systems, a glide path of 1 year is provided for BRSR reporting or assurance under BRSR core in the annual report. This phased approach allows listed entities adequate time to adopt to the new requirement and ensure comprehensive and accurate reporting. The update emphasizes the importance of sustainability and responsible business practices, ensuring that listed entities transparently report their ESG performance. By mandating the implementation of data capture system, SEBI aims to improve the quality and reliability of BRSR data. Okay, some other amendments pertaining to timings, etc. Gap between meetings of the Risk Management Committee, which is Regulation 21. Now, the maximum permitted time gap between two consecutive meetings of RMC has increased from 180 days to 210 days. On the Regulation 26A, which is vacancies of key managerial person, the timelines for filling up vacancy in the office of KMP, where the approval of statutory authorities is required, has been extended from 3 months to 6 months. The KMP for this regulation includes the CEO, Managing Director, Whole-time Director, Manager, or a Chief Financial Officer. Moving on, timing for applicability of LODR regulation to high-value debt-listed entities, which is Regulation 15, has been extended to March 31, 2025. Earlier, it was March 31, 2024. On Regulation 29, which is on prior intimation of board meetings, where the primary update here is the reduction of timelines to 2 working days for all events prescribed under Regulation 29. Previously, the timeline for intimation varied from 2 working days to 11 working days, depending on the nature of the board meeting agenda. Now, this change basically simplifies and standardizes the entire process. Additionally, the amendment specifies that prior intimation is not required for the determination of the issue price for fundraising if done through qualified institutional placement as per the ICDR regulation. This exception reduces the administrative burden and allows for more timely and flexible execution of such transaction. Furthermore, prior intimation is now required only for fundraising proposal that involve the issue of securities. Now, this targeted approach ensures that only significant financial decisions that could impact the market or investor interest require prior notice, thereby focusing regulatory oversight on critical activities while easing compliance for less impactful decisions. Okay, now to SEBI AIF Second Amendment Regulation 2024. On 25th of April 2024, SEBI amended the regulation. These amendments introduced several key changes aimed at enhancing the operational flexibility and regulatory compliance for the AIFs. One of the significant updates is the introduction of the dissolution period for AIF schemes. A scheme can enter into a dissolution period under specific conditions, during which it must file an information memorandum with SEBI through a merchant banker. The dissolution period cannot extend beyond the original tenure of the scheme, and no fresh commitments or new investments are allowed during this time. This period is designed to facilitate the orderly winding down of the scheme that have unliquidated investments, providing a structured process for liquidation. Additionally, the amendment provides greater flexibility for dealing with unliquidated investments. If an AIF fails to liquidate its investment within the designated period, these investments must be distributed in specie to the investors. This ensures that the investments are returned to the investors in a timely manner, even if they cannot be sold. The amendments also include new rules for the valuation and reporting of unliquidated investments, requiring independent valuation and offering an exit option to dissenting investors. If the manager of the AIF arranges a bid for at least 25% of the value of the unliquidated investment, dissenting investors are given the opportunity to exit fully from the scheme. These regulatory changes are aimed at enhancing investor protection and ensuring that winding down of AIF scheme is handled efficiently and transparently. By providing clear guidelines and additional flexibility, SEBI aims to strengthen the operational standards of AIFs and improve their compliance with regulatory requirements. Okay, moving on to SEBI circular dated 26th April 2024 on encumbrance on equities by Category 1 and Category 2 AIFs. This circular basically provides a framework for Category 1 and 2 alternative investment funds to create encumbrance on the equity of investee companies. This framework is designed to facilitate the borrowing by investee companies and is intended to provide greater flexibility and ease of doing business for these AIFs. Key points for the framework of encumbrance on equity by Category 1 and 2 AIFs primarily will include creating an encumbrance on the equity of investee companies specifically for the purpose of facilitating borrowing by the investee company, particularly those involved in infrastructure projects. This framework requires explicit disclosure in private placement memorandum, the PPMs as popularly known, about the creation of such encumbrance and associated risk. The encumbrance must be used strictly for the development, operation, or management of the investee company and cannot be diverted to other investments. The duration of the encumbrance cannot exceed the residual tenure of the AIF scheme. Existing encumbrance created before 25th of April 2024 are allowed to continue if they were disclosed in the PPM, and if not disclosed, consent from all investors must be obtained by 24th of October 2024. Otherwise, the encumbrance must be removed by January 24, 2025. Moreover, AIFs must ensure that borrowings against the encumbrant equity are utilized solely for the specified purposes. There should be no additional liability on the fund or its investors beyond the encumbered equity in case of a default by the investee company. The framework explicitly prohibits AIF from extending any form of guarantee for the investee company. To ensure proper implementation, the standard-setting forums of AIFs, in consultation with SEBI, will formulate and publish standards. These standards aim to ensure that the encumbrance created is utilized effectively for debt facilitation within the infrastructure sector. These measures are intended to enhance the operational flexibility of AIFs while ensuring robust regulatory oversight and protection of the investors. Basically, by allowing encumbrance on equity, AIF can facilitate the raising of debt for their investee companies, particularly in the infrastructure sector, as I've already mentioned, thereby promoting growth and development within the crucial industry. Okay, now next, let's move on to the SEBI ICDR amendments. Okay, now in May 2024, SEBI introduced several amendments to SEBI ICDR regulation to basically to streamline the processes and provide greater flexibility in capital raising activities. Let's delve into the details of some of these amendments. Regulation 14, primarily on the non-individual shareholding permitted to contribute towards minimum promoters contribution, popularly known as MPC. Previously, only certain regulated entities could contribute towards MPC to meet any shortfall. Now, with this amendment, non-individual public shareholding at least 5% of the post-issue capital along with other entities forming part of the promoter group are now permitted to contribute to MPC without being identified as promoters. This broadens the pool of eligible contributors, helping companies meet their funding requirements more easily, especially those with diverse shareholding structure. Regulation 15(1)(b). Now, this basically talks about inclusion of compulsorily convertible securities in the computation of MPC. The amendment basically allows equity shares arising from conversion of fully paid up compulsorily convertible shares held for at least 1 year before filing the DRHP to be included in the MPC computation. This change provides companies with more flexibility in meeting the MPC requirement by recognizing these convertible securities as part of their contribution. Moving on to Regulation 46, Sub-Regulation 3, which talks about extension of the bid offer closing date by 1 working day in case of any force majeure event. Now, in case of any force majeure events, the mandatory extension period for the bid or offer closing date has been reduced from 3 working days to 1 working day. This amendment aims to prevent unnecessary delays in the IPO process, enabling quicker resolution for disruptions and more efficient capital raising during unforeseen circumstances. Moving on to the fresh filing of offer for sale to be based on one of the criteria and not both. Previously, changes in the OFS required fresh filing based on both the issue size and the number of shares. The amendment clarifies that the requirement for fresh filing will be triggered based on one of these criteria, either the issue size in INR or the number of shares, but not both. This change removes ambiguity and simplifies compliance for issuers, providing greater certainty in the OFS process. So we've seen these amendments reflect SEBI's ongoing effort to make capital market more accessible and efficient for issuers while ensuring robust investment protection. By broadening the pool of contributors to MPC, including convertible securities in the MPC computation, reducing delays due to force majeure events, and clarifying the criteria for OFS filing, SEBI aims to create a more streamlined and flexible regulatory framework here. Okay, on the BRSR consultation paper. Here, SEBI issued a consultation paper on 22nd of May 2024 proposing changes to the provision of BRSR and BRSR core under LODR regulations. Let's have a look at that. So, the need for this consultation paper arose from the feedback received from various stakeholders about the complexities, the cost associated with current BRSR framework. The goal is to simplify the reporting process, make it more relevant and less burdensome, and ensure that it aligns with the global best practices. This approach is expected to enhance the overall quality of sustainability disclosures while making it easier for companies to comply with the regulations. Now, let's uh, discuss the key proposals in the consultation paper. The first one is the redefinition of value chain partners. Now, the proposed uh, changes aim to redefine value chain partners to cover only significant partners, specifically those comprising 2% or more of the listed entities' purchases or sales by value, and cumulatively have to be at least 75% of the equity entities' purchases or sales. Now, this reduces the compliance burden on smaller partners while ensuring that key partners are still included in the disclosures. The next one is on the integration of green credit program. The consultation paper basically proposes integrating the green credit program as a leadership indicator under BRSR. Green credit generated by the company from initiatives like tree planting can be reported. It's basically aligning with the Ministry of Environment, Forest and Climate Change notification. This provides a structured way to highlight environmental efforts and achievements. Next point could be flexibility in assurance requirements. Now, companies will have to adopt to choose between assessment and assurance for BRSR core disclosure. This flexibility is intended to reduce the cost and administrative burdens associated with obtaining formal assurance while still maintaining the quality and reliability of disclosures. From financial year 2023-24, companies can opt for either. But from financial year 24-25 onwards, the term assessment will replace assurance in regulatory language, providing more cost-effective compliance path. Next would be voluntary reporting for the first year. For the first year of ESG disclosures for the value chain, which is 24-25, reporting of previous year numbers will be voluntary. Therefore, these proposed changes are expected to significantly reduce the compliance burden on companies, making it easier and less costly to fulfill reporting obligation. By focusing on significant value chain partners and integrating environmental leadership indicators like the green cards we discussed, the updated framework aims to provide more meaningful and impactful sustainability disclosures. The flexibility in assuring the assurance requirements further aligns with global standards, and it enhances the overall credibility and utility of BRSR. Okay, moving on, and finally, we will cover the recent announcement by ICAI. So, ICAI has issued guidance on non-compliances observed during the quality review by the Quality Review Board, and another one is they have come up with the checklist on the Ind AS. So, both these points will be discussed in the subsequent slides. Okay, I believe this is an important slide for all the practitioner chartered accountants having a firm or covered under the ICAI regulation. So let's talk about the top themes those were observed in the QRB. So the first one could be engagement and quality control standards. The QRB noted that many firms did not fully comply with the engagement quality control standards. This included failures in documenting the review process and lack of evidence that quality control reviewer had appropriately reviewed the audit documentation and conclusions. Further, the QRB emphasized that many firms did not have policies and procedures designed to provide reasonable assurance that the firm and its personnel comply with professional standards and regulatory requirements. Moving on, non-compliances were observed in the reporting of the CARO and the internal financial controls. Basically, the observation was that the firms often did not adequately document their evaluation of the internal control, or they failed to provide sufficient evidence supporting their conclusions, which takes us to the inadequacy of audit documentation. Now, this is a recurring issue, basically, which was observed, which talks about the inadequacy of the audit documentation. Many audit firms did not maintain proper documentation to support their audit findings, which is crucial for ensuring the transparency and reliability of the audit process. We really can't stress more on the importance of the audit documentation. Moving on, there was an observation on the insufficient training and competency. The QRB found that some audit firms lacked sufficient training programs for their audit staff. This basically resulted in the auditors not being fully aware of the latest auditing standards or latest regulatory requirements or the changes in the accounting standard, finally impacting the quality of the audit. Then, of course, there was a point on the non-compliance with the auditing standards. Instances were noted where the audit firm did not comply with the established auditing standards, including those related to risk assessment and response, and the use of external confirmation, which of course is the backbone of any audit. This non-compliance could lead to incomplete or inaccurate audit conclusion. And of course, one of our regulators' favorite, which is the ethics and independence and objectivity. This was also noted in the QRB observation. Some auditors were found to have conflict of interest that compromised their independence and objectivity. Included financial interest in the audit client or other relationship that could influence the auditor's uh, impartiality. Basically, the ICAI guidance aims to enhance the overall quality of the audit conducted by ensuring that the audit firms adhere to the highest standards of professional practice. Now, by addressing these non-compliances, the ICAI seeks to restore confidence in the audit process and ensure that the financial statements are reliable and provide a true and fair view of the financial position of the entities being audited. This will ultimately lead to improved transparency and trust in the financial reporting ecosystem. Okay, moving on, the ICI issued the Ind AS disclosure checklist, which provides guidance on the relevant disclosure requirement under Ind AS. This checklist acts as a ready reference for disclosure requirements and includes amendments effective from 1/4/2023. The checklist contains only disclosure requirements, therefore it should be read in conjunction with the standards and regulatory requirements and other related guidance material. Now, with this, we end our session, and thank you for your attention. These updates and amendments are critical for staying compliant and ensuring that our practices align with the latest regulation. If you have any questions, please feel free to write to us and we will get back to you. Thank you.